Forming an LLC can be one of the smartest moves you can make as a business owner. It can protect your personal assets, create structure, and open the door to serious tax savings. But here's a problem. Most business owners form an LLC and then unknowingly destroy the benefits by making a few common mistakes. I'm David from Accounting Fresh, and today I'm going to break down the biggest LLC mistakes I see business owners make all the time and how to avoid them so your LLC actually works for you and not against you. Let's get into it. The first mistake is getting an EIN and then never using it. Your EIN is basically your business's social security number. It's what separates you from your company. Here's what should happen. You open a business bank account using your EIN. All business income goes into that account. All business expenses come out of that account. What I see instead is incoming going into personal accounts, expenses paid with personal credit cards, everything mixed together. This is called commingling, and it's very dangerous. If you ever get audited or sued, a court can decide your LLC isn't real, and suddenly your personal assets are exposed. And on top of that, banks and lenders want to see clean business financials. If everything is mixed up, you won't qualify for loans, lines of credit, or financing when you need it most. So the bottom line, if you have an LLC, act like a business. Use your EIN number, use business bank accounts every time. Mistake number 2, not all income is taxed the same, and this mistake alone costs business owners thousands of dollars per year. There are 3 main types of income. Active or ordinary income is number 1. This is income from services, consulting, contracting, trades, coaching, etc. This income is subject to income tax and self-employment taxes at 15.3%. Once profits start climbing, usually around $50,000, this tax gets painful. That's why many LLCs eventually make an S-Corp election to reduce self-employment taxes. Passive income is the second type. Think long-term rental real estate. Passive income is generally not subject to self-employment taxes, which changes how we structure things. Portfolio income, dividends, interest, capital gains, usually later stage wealth. Each income type requires different planning. If you don't understand how your LLC earns money, you can't structure it correctly, and you overpay in taxes. Mistake number 3, you don't need to be a CPA, but you do need to understand the basics. Here are the key forms every LLC owner should recognize. SS-4 is used to apply for an EIN number. Schedule C is for single-member LLCs filed with your personal 1040 tax return. Form 1065 is a multi-member LLC/partnership, and these get K1s, and this is how profits pass through to the owners. W-9s and 1099s when paying contractors. I see owners skip steps simply because no one explained them. I see owners skip steps simply because no one explained these to them. Understanding these forms help you stay compliant, keep your books clean, avoid IRS issues and audits, and work with your accountant instead of blindly trusting them. So let's be real, sometimes business expenses end up on personal cards. That's okay if you handle it correctly. What you don't want to do is ignore it, randomly transfer money, or create taxable income by mistake. The correct way is through proper reimbursement with documentation, and in some cases, an accountable plan. This keeps your books clean, your deductions valid, and your liability protection intact. So here's some bonus mistakes. Ignoring business credit. The LLC should build its own credit profile and not rely on your personal credit forever. Good business credit means better financing, better vendor terms, and easier scaling.